Picture this. You just got your paycheck. Rent's due in 3 days. You've got $340 in checking, a Robinhood app with 2 stocks you bought on a whim, and a nagging feeling that you're supposed to be investing more, saving more, doing more. But every finance video you watch just tells you to pay yourself first and cut out lattes, and none of it actually explains why some people build real wealth while others, making the exact same income, stay stuck paycheck to paycheck for a decade. Here's the thing. You've probably heard of the 90-10 rule before, and I guarantee what you've heard is wrong. Or at least it's not the version that actually matters. My name is Jackson, and I spend way too much time thinking about how ordinary people actually build wealth versus how we're told they build wealth. If you're someone who feels like you're doing everything right, budgeting, saving a little, maybe investing a little, but your net worth still isn't moving the way you expected, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. So let's start with what most people think the 90-10 rule is. Most personal finance content will tell you the 90-10 rule is about budgeting. Live off 90%, invest 10%. Or sometimes it's framed as Warren Buffett's investing rule. Put 90% of your portfolio in a low-cost S&P 500 index fund and 10% in short-term government bonds. That's a real thing Buffett actually said in a letter to his trustee about his own estate. Real quote, real strategy. And honestly, not bad advice for the average investor.
But here's what most people don't realize. That's not the 90-10 rule that actually separates people who get rich from people who stay comfortable but stuck. That rule is about asset allocation. It has nothing to do with the thing that actually determines whether wealth compounds in your life or evaporates. The real 90-10 rule that shows up again and again when you study how wealthy people actually operate is this. 90% of their wealth-building decisions are boring and repeated, and only 10% are exciting and occasional. Let me say that again, because it's the opposite of how it feels from the outside. Look, when we see a billionaire, or even just a self-made millionaire on a podcast, we hear about the one company they sold, the one stock that 10x'd, the one real estate deal that changed everything. That's the story that gets told because it's dramatic. Nobody makes a viral clip out of, and then for 22 consecutive years, I contributed $500 a month to an index fund. But here's where it gets really interesting. If you actually look at wealth data, the Federal Reserve Survey of Consumer Finances has tracked this for decades. The vast majority of self-made millionaires in America didn't get there from one big swing. They got there from an incredibly boring, repeated 90% and a small, occasional 10%.
Thomas Stanley's research on self-made millionaires, the guy who literally spent his career studying this, found that the majority of American millionaires are not doctors or tech founders. They're business owners, engineers, teachers, and accountants who lived below their means for decades and consistently invested the difference. Boring people. Boring decisions. Repeated a few thousand times. Now, you might be thinking, okay, Jackson, so the secret is just be consistent? That's not a secret, that's just what my dad says. And you're right to push back on that. Because be consistent without understanding the math and the psychology behind it is useless advice. So let's actually break down what the 90 and the 10 mean in dollars. Let's say you're 28 years old, making $65,000 a year, pretty close to the median income for someone in their late 20s in the US. The 10% moment might be you get an $8,000 bonus one year and you invest all of it. Great, good for you. That's a real, meaningful action. But here's the math that actually builds wealth. If you invest just $400 a month, that's about $13 a day, less than most people spend on subscriptions and food delivery combined, into an S&P 500 index fund, averaging a historical 10% annual return before inflation. Here's what happens. After 10 years, roughly $76,000. After 20 years, roughly $274,000. After 30 years, roughly $790,000. That $8,000 bonus you invested one time, even if it also grew at 10% for 30 years, it becomes about $139,000. Impressive on its own, but it's dwarfed by the $400 a month habit
repeated 360 times.
That's the 90-10 rule in action. The 10% got you $139,000. The 90% got you $790,000. The boring decision, repeated relentlessly, outperforms the exciting decision made once by more than 5 times over. Here's what should sting a little. Most people spend 90% of their mental energy chasing the 10%, the hot stock, the side hustle that might blow up, the crypto coin, the one trade, and only 10% of their energy on the habit that's actually doing 90% of the work. So why do we do this? Why does our brain default to obsessing over the exciting 10% instead of the boring 90%? This comes down to something behavioral economists call variable reward psychology, the same mechanism that makes slot machines addictive. When an outcome is uncertain but potentially huge, your brain's dopamine system lights up way more than it does for a predictable, guaranteed outcome. That's been shown repeatedly in research from people like Robert Sapolsky studying dopamine and anticipation. Uncertainty itself is exciting to the brain, more exciting than certainty, even when certainty is the better bet. A guaranteed $400 monthly contribution feels boring because there's no uncertainty, no story, no what if this changes my life. A stock that might 10x feels thrilling because of exactly that uncertainty. Your brain is literally wired to overvalue the thrilling 10% and undervalue the boring 90%, even when the math says the opposite should be true. This is also tied into what's called present bias. We're wired to weight immediate emotional payoff over delayed, unglamorous payoff. It's the same reason it's easier to convince yourself to buy a lottery ticket than to convince yourself to bump your 401k contribution by 2%. Here's the analogy that I think makes this click. Imagine wealth building is like farming. The 90% is watering the crop every single day. Unglamorous, repetitive, invisible progress. The 10% is the once-a-season storm that either helps the harvest a little or hurts it a little. Most people spend all their attention watching the sky for storms and forget to water the field. Now, let's talk about why this actually costs people real money, not just theoretically. I want you to think about the average person's financial year. According to surveys from places like Bankrate, a huge chunk of Americans, often cited around 55 to 60% in various consumer surveys, say they don't have enough savings to cover a $1,000 emergency. Meanwhile, that same population is far more likely to be able to tell you what a meme stock did last week than what percentage of their paycheck went into retirement contributions. That's the 90-10 rule, inverted. Energy and attention going into the 10%, while the 90% that would have actually built the emergency fund and the retirement account gets ignored because it's boring. Here's another place this shows up: lifestyle creep. You get a raise. That's a 10% moment. Exciting, feels like a milestone. But then the 90%, what you do with that raise every single month afterward, quietly determines whether that raise built wealth or just built a slightly nicer apartment and a slightly nicer car payment. Most raises get absorbed into lifestyle within about a year. That's not a coincidence. That's the 10% getting all the attention while the 90% runs on autopilot in the wrong direction.
Now here's the part that I think most creators miss when they talk about consistency. The 90-10 rule isn't just about money habits. It's about decision architecture, meaning the wealthy don't rely on willpower for the 90%. They remove the decision entirely. Think about it. If building wealth required you to make a good decision every single day, should I invest today or should I not, you would lose that fight eventually. Everybody does. Discipline is not infinite. It's actually a depletable resource, something researchers like Roy Baumeister demonstrated repeatedly in studies on what's called ego depletion. You have a limited amount of willpower each day, and it gets used up. So the people who actually pull off the boring 90% aren't more disciplined than you. They just automated the decision, so willpower isn't required. Automatic transfers on payday, automatic 401k contributions, automatic investing, before the money ever sits in a checking account, tempting you. This is the actual secret behind the 90-10 rule. The 90% isn't powered by motivation. It's powered by automation.
Let me give you a comparison that shows this play out. Imagine two people, both starting at age 25, with the same job and the same $50,000 salary.
Person A spends a lot of mental energy trying to find the next big opportunity. Day trading occasionally, jumping into a hot stock when a friend mentions it, maybe putting a chunk into a business idea that doesn't pan out. Person A does eventually have one good year where a stock tip nets them $12,000. That's their big 10% win. Person B does something almost boring to describe. Automatically invests $350 a month into a target date index fund every single month without fail for 20 years, and basically never thinks about it otherwise. By year 20, assuming average historical market returns, Person B has around $255,000 just from that boring automated habit. Person A's $12,000 win, even if it also grew at market rates, turns into something in the ballpark of $60,000 to $70,000, depending on when it happened. And that's assuming they didn't lose money on any other speculative attempts along the way, which, statistically, most people chasing the exciting 10% do. Person A isn't smarter. Person A isn't luckier. Person A just correctly identified which 90% deserved the energy and which 10% didn't need to be obsessed over.
Okay, so now you might be thinking, great, Jackson, I get it. Be consistent. But what do I actually do this week? Fair. Let's make this concrete. Step 1. Identify your current 90-10 split. Is 90% of your financial energy going into the boring stuff that compounds, or into the exciting stuff that mostly doesn't? Be honest. If you check your brokerage app more than you check your retirement contribution percentage, you already know the answer. Step 2. Automate one boring decision this week. Just one. Set up an automatic transfer, even if it's $50, into an index fund or your retirement account on the day you get paid. Step 3. Give yourself permission to have a small, contained 10%. A small amount you're allowed to use for the exciting stuff, the individual stock, the speculative bet. Somewhere around 5 to 10% of your total investable savings is a reasonable ceiling for this. Enough to scratch the itch, not enough to derail 2 decades of compounding if it goes to zero. Step 4. Revisit this every 6 months, not every day. The boring 90% doesn't need daily attention. That's actually the whole point. Checking your investment account daily doesn't make it grow faster. It just makes you anxious and more likely to make an emotional decision that breaks the automation. Here's the thing I want you to walk away with. Every time you see a headline about someone who made it big off one decision, one stock, one business, one lucky break, remember, you're seeing the 10%. You're not seeing the years of boring, repeated, unremarkable decisions that either set up that lucky break or quietly built the real wealth underneath it. The wealth nobody makes a viral clip about. The 90-10 rule isn't about allocation percentages in a portfolio. It's about where you put your energy, your attention, and your discipline. 90% boring, automated, repeated. 10% exciting, occasional, contained. If you're someone who's been chasing the exciting 10% and wondering why your net worth isn't moving, this is probably why. And the good news is, this is completely fixable, starting today with one automatic transfer. If this video helped you see your money differently, hit that subscribe button. Drop a comment telling me what your boring 90% habit is going to be starting this week, and I'll see you in the next one.